All right. Well, good morning, everybody. I want to thank everyone for joining us. My name is Mike Weber. If you don't know me, my name is I'm a managing partner of Weber Research and Advisory, and it's my pleasure this morning to host the LNG panel for Capital Link. Before we begin and kind of get into intros and the way this is going to work, I wanted to thank Nick Bornozis and Annie and the rest of the Capital Link group for putting this on in difficult circumstances. So it's a great job by you guys. Um, so the panel this morning, we're honored to have. It's a fantastic panel to kind of get a sense of where the LNG market is. We've got Oystein Kalleklev from Flex LNG, the CEO of Flex. Iain Ross, CEO of Golar LNG. Mark Kremin, CEO of Teekay Gas Group, and Jefferson Clarke, Managing Director at Poten and Partners. So again, a great group to really get a sense of where the market is today and where we're headed for the rest of 2020. So thank you, gentlemen, for joining us.
Thank you.
Pleasure.
Thank you.
So the way this will work is I'll throw this out. Start throwing out questions to the group. I'll probably kind of pitch them initially to individuals, but feel free at any point to weigh in. I know everyone's going to have a take or kind of a differentiated view on the different topics at hand. But I wanted to start first with the market kind of grappling with COVID-19, and maybe throw this one out first to Mark and then Oystein. You know, really the two primary LNG carrier owners on the panel. In terms of COVID-19 and what we're starting to see in terms of force majeure claims, we saw Petronet the last couple of days start talking about not taking cargoes. It seems like some of that language is going to be within some of the contracts, and at least it's going to, some of these claims are going to be going to arbitration or courts. I'm just curious from your perspective, how do you think about your business and your cash flow streams in that environment? How does it impact you as a ship owner? And do you think we are seeing the worst of this now, or do you think this becomes a much bigger issue as we move through the second quarter? So I'll throw that out to Mark first, and then Oystein will kind of pivot to you.
Sure. Well, thank you. There's a lot of parts to this question, so I'll try to split up a bit and go from there. There are two parts to this. Obviously, there's the revenue side and there's the expense side or the logistics side. And I think it's important to start with the revenue side, even though most of the activity is on the expense side. On the revenue side, I'd like to reiterate, we have not seen any sign that charterers will try to renegotiate or cancel. We've reviewed our charters for force majeure clauses, and they typically in LNG don't have any. That includes any charter done on shell time, which is the industry standard. And those charters that do, the force majeure must run for 12 months or more, during which period the ship owner is going to get paid higher. So from a revenue standpoint, we don't see from a shipping side any real impact. Now, obviously, you've mentioned the cargo cancellations that we have seen. But I'll turn a little bit more to the expense side and the logistics side, which is the real activity we're seeing on the ships. At least in Teekay's side, and I think most operators, crew relief is pretty much impossible right now. So we have been able to get fresh provisions. We've got the prescriptions we need. The crew morale is excellent. But the fact of the matter is we haven't been able to get the crews off and on. And in some sense, that's helpful. The best thing to avoid the virus is to keep the ships hard against people coming on, whether it's port authorities or mooring masters or superintendents or whatever. But over time, this could become a bigger issue as the crew begins to get fatigued about being on board for some time. And maybe I'll lead it on to others, or happy to detail more.
Yeah, no, I'm just curious how you solve for that. I mean, I struggle to kind of think of a way you can kind of get ahead of that now, but as you see that kind of coming, right, it certainly seems what you're saying sounds pretty intuitive. How do you try to prepare for that in the next handful of weeks?
Well, fortunately, we have some big industry players hopefully behind us, the International Chamber of Shipping, the ITF. Others are trying to get shipping raised to the level that airlines and others are. It's essential product we're moving here. And it's not just oil and it's not just gas, but foodstuffs and medicals. Again, we're all in the same place, whether it's Maersk or Flex or Teekay or Golar, whoever. So hopefully we can get an industry-wide NGO or even government a push to get the crew off and on. In the meantime, as I said, we've stocked up on provisions and spares and just trying to deal with the crews the best they can. Even if they can get off, it's difficult for them to get a flight home anyway. Flights have really seized up. So this might be the best place for these guys at the moment.
Okay, fair enough. Oystein, any thoughts to add there?
No, I agree with Mark. I think, for us, the time charters we enter into is for worldwide trade. So it's not like the ships are going from A to B any longer, which it was how it used to be in the past. So if your ship was trading the same route, you would be more vulnerable to suddenly some port shutting down. Today you trade worldwide, so we don't really have any force majeure clause for, let's say, one area of ports closing down. We have an example of this happening here in China in February. Of course, the import numbers on a weekly basis dropped from around 1.5 million tons all the way down to 0.5 million tons in the middle of February. And what happened then was, of course, JKM hit its all-time low. But also what happened, which is peculiar for this time of year, was the fact that you suddenly had a big spike in floating storage. So you went from having about 0 ships to all the way up to 25 ships. And actually that supported freight rates at the end of February. Rates softened in the beginning of March because all those ships came into the market again. And then it's been strengthening now the last 2-3 weeks, and with kind of the JKM prices also going up again. So if you look at India now, which is maybe the next candidate, it's hard to tell how big impact it will be on shipping, because they certainly need to import more LNG. It's not like they will stop. If you look at China, their pipeline imports fell by 20%, but LNG import only fell by 5%. So there will probably be more inefficiencies. Floating storage has already started to pick up again. My latest number is around 15 ships now getting into floating storage. So that will, in the short term, kind of support the LNG shipping market. It's more the problem that the end users and of course our customers are not able to move the cargoes, which is unfortunate.
Right. Now, and I want to touch on that floating storage dynamic in a second with Jefferson, but just to stay on this for a second, in terms of the actual mechanics of what happens when you have say a spot cargo or even term business that's involved in that kind of force majeure claim or situation like this, are you still getting paid? Are you building liquidated damages? I know it's early, but just mechanically, how should we see this filter through results kind of sector wide over the next couple quarters?
We have had ships which have delayed discharge, and of course we are on time charter. So it's the time that matters. So as long as the clock is ticking, we are getting paid. So there's not really any problem that people stop paying if you are delayed, because it's not our fault.
Yeah, just the only issue would be if they're not paying you because there's a force majeure clause, which it seems like that's not the case now that cash flow is still on schedule. Yeah. Okay, yeah. Mark, it looked like you had something to add there.
Yeah, just to reiterate, under shell time, which is the standard, if there is no force majeure clause, so we're not seeing anything in time charters. And even in those special cases, the long 25-year type of contracts that may have a force majeure still get paid for 12 months. So we've actually seen some diversions, and the payment has been unimpacted. Our earnings, our guidance is not impacted by this.
That's great. That's great to hear. Maybe kind of pivoting and kind of what I kind of touched on a second ago with Jefferson, in terms of what Poten is seeing right now, in terms of the way this is impacting the LNG market, both in terms of floating storage, and I want to kind of differentiate between anything structural and maybe demurrage and some delayed discharge. But then just more generally, Jefferson, how are you seeing this impact kind of the day-to-day trading within the LNG markets?
Yeah, echoing a little bit of what Oystein was saying, we clearly see floating storage as kind of the safety valve over the next couple of weeks and even the next couple of months for the LNG market in general. We measure it a little bit differently at Poten, but come up to the same results. We measure floating storage as a percentage of how much LNG is on the water versus what was imported that month. So for example, back in October, they were importing around 28 million tons of LNG that month. There was roughly around 17 to 18 million tons of LNG on the water at that time. So we calculate kind of floating storage as around 68% of the market. Similar to what Oystein was saying, then you saw a discharge of all the cargoes, and now we're actually at historical lows for floating storage of around 37%. That was just at the end of last month, but we're seeing it climb back up again. We're seeing it climb back up again as fleet speed drops. So this is going to have a positive impact, at least in the short term, on the LNG shipping market. We're seeing rates climb already, especially in the spot market. And really importantly, we're seeing a lot of multi-month fixtures out there, which we define as anything above 6 months to a year. So you're seeing a lot of charterers that are playing it very conservative. The energy majors are playing it very conservative. They want to ensure that they have the vessel availability to deliver their cargoes. They're not looking to take any chances. So you quickly saw a rapid change of where energy majors were trying to sublet their vessels now to chartering in. And for us, the greatest driver of spot rates is always how much vessel is available on the market, on the spot market. So with energy majors no longer a competitor, but a source of the fixtures, we're actually seeing vessel availability shrink very quickly, and spot rates starting to climb very quickly.
Okay, that's helpful. And the inventory methodology sounds a lot like the way we actually think about stockpiles for other commodities relative to consumption, kind of more similar to the way we think about maybe even iron ore and even crude and product, which makes sense. Iain, I wanted to throw it to you for a second just to talk about what you're seeing in terms of potential storage opportunities for the legacy Golar fleet, but then also, being focused on the downstream and the one area of the market that really and truly benefits from a low cost environment. Aside from the storage, I want to dig into any kind of demand response, but maybe let's stop there. Let's just start first with the storage opportunities or inbound inquiry from either traders or end users. Are you seeing any pickup there in terms of infrastructure needed to build out that that emerging market sink?
Thanks, Mike. I guess the first thing is I would echo my colleagues on the panel saying that our immediate priority is to look after the welfare of the crew, and that's been covered. But a huge amount of activity and resources going into making sure that their welfare is up to scratch. In terms of the shipping market, yes, we've also seen a pickup in the immediate spot rates. Noting that, we took a decision about a year ago to try and put more of our fleet onto some form of term business, be that index linked or on straight charters. And certainly on the index link numbers, that curve has bottomed out and picked up again. Well, we don't know. I mean, we were enjoying an arb between Europe and the Far East last week, and as of this morning, I believe that arb's pretty much closed again. So we don't know how quickly that will cycle open and shut. But I do agree in the floating storage thesis, less about stockpiling, more about slow steaming until hopefully the rates pick up for the owners of the cargo to discharge. In terms of moving to the downstream side, I mean, that's a good side of the business to be in. I would have thought that as this continues to propagate, as low LNG prices are maintained over the coming months and perhaps years, we should see an uptick in the interest in FSRUs. As gas becoming a low cost, cheap form of entry into gas fueled energy. And directly in the downstream environment in Latin America, of course, we managed to get our power station in Brazil at Sergipe up and running this week with COD, and that allows us to immediately start selling merchant power into the market. And when we have such a cheap LNG price, we can buy LNG very efficiently from a cost point of view, and when the price is right, sell that into the power station. So I think the downstream market will continue to grow on the back of low-cost LNG, and the shipping market will do what it does. It will cycle, and we will have things that we can predict, and we'll have things that will come out of the blue and surprise us both on the upside and the downside in the coming weeks.
You know, just in terms of, you kind of touched on it briefly, but in terms of a tangible demand response, you know, I feeling it's a bit too early because we still have containment mechanisms kind of still kind of rolling across the globe. But I'm just curious, Iain, you know, you've got, you know, there'd be kind of green shoots or of a demand response for lower commodity prices on big assets, which probably take a little bit longer to materialize. But you guys also have a couple pilot programs in the market right now in Brazil, where maybe there's, you know, you can get maybe more of an immediate feel for any kind of demand response to kind of cheap pricing. It still might be too early, but I'm just curious, are you seeing any things from either those programs or your day-to-day interactions with customers that indicate there is starting to be a demand response to cheaper LNG? And if not, that's fine. It's you know, it's there's obviously a lot going on. I'm just curious, when do you think we'll actually start to see that have a physical, or manifest itself in the market in some kind of physical way?
So I think it's just, I have two sort of answers to that. One is, if you look at China and China's pickup, and I think somebody's already mentioned that. My understanding is 2020 is the end of the 5-year plan in China, despite the fact they've had a big shutdown for a couple of months. I would imagine there will be quite a lot of industrial activity in China to try and recover some of the lost ground on closing out that 5-year plan. And I wouldn't be surprised if we see the Chinese economy cranking up faster than people might imagine. And I've heard numbers of 90-95% capacity in terms of industrial ability to perform tasks. We have a project for an FSRU conversion happening in China at the moment, and that's had a little bit of a stumble, but has recovered fairly quickly, and the teams are back to work there. So I haven't been there, but anecdotally, China's responding very well in terms of a recovery. So that's at one end. At the other end, in terms of Latin America, where we have a couple of terminals that are moving ahead, the difference there is we're trying to create our own demand rather than waiting for an existing demand to pick up. And what we are seeing is that low LNG prices are making what was already an attractive proposition to convert from diesel or heavy fuel oil to cleaner and cheaper LNG. As LNG prices drop, of course, that becomes even more attractive. And we're making really good progress on 2 terminals in Latin America to follow one from Sergipe.
Okay, that's helpful. Mark, this is the market you guys play in more and more, a bit in a different way than Golar, but you're obviously active in Bahrain and other markets where you're providing infrastructure assets beyond simply marine midstream. So just, Mark, I'm just curious, are you starting to see any green shoots in terms of a demand response? And if not, from the lower commodity environment, that would really kind of pertain through to the entire back half of the year, maybe kind of stripping out even kind of the COVID period we're in now. And if not, when do you think we'll start to see that kind of play out in the market?
Yes, the good news is we are seeing it. So I certainly can support what everyone's saying here. We are seeing it in the form of multi-month charters. So we just fixed one of our ships on multi-month to an international trader, and we are on subs to shortly fix another one to an Asian utility. And these are all through the end of the year. So we'll be over 98% fixed this year. We just have a half ship not fixed out of our 47 LNG carriers. These are all on fixed rate charters all the way through the end of the year. And the point of this is, yes, these multi-month charters taken by traders and utilities indicate that these guys see long-term, near-term demand. So we are absolutely seeing it. As for the rates, I also think these are been holding surprisingly steady, mostly because of Asia. And so, yeah, but more so on the multi-month opportunity than the rate increase is what we're seeing.
Gotcha. Oystein, curious what you're seeing on that end, both just in terms of a demand response, but also having had one of the larger spot fleets in the market. Just curious whether how you're seeing the marine environment and the LNG carrier market react to the tighter arbitrage. Is it having an impact on the way your customers think about how they book their freight? It's obviously been kind of a bit of a clunky process as the market has kind of become more merchant, with people not covering capacity needs at times. And
I think it's a good thing for kind of the freight market. You have this oil crash right now. It's like when McDonald's sells Big Mac at $1, they get a lot of more customers. So the same thing is true with energy. And you know, it's probably a bad analogy because coal used to be the junk food of energy. You know, it's cheap and it gets you warm quickly, but you feel bad afterwards. Right now, LNG is cheaper than coal. It's you know, so cheap that also you could possibly see contract prices below spot prices when you are approaching autumn. And then, of course, we have a very tight arbitrage, but it's not always kind of the arbitrage in that, different spaces. So different bases, also the arbitrage in time. So it's a bit like physics where you have space time, because what you have now, it's a tight arbitrage between the different basins, but you have a big arbitrage when you're getting into time, because we are now going to get the contango or the super contango from oil. After the oil slumped down to $25, the oil curve went from backwardation to contango, and this means that once the oil price slump falls, gets into the LNG contract prices, the whole LNG curve will be in contango. We have before this happened, we had contango in the spot LNG, which is basically 30% of the market, while the contract LNG was in backwardation. Now both of them, 100% of the market will be in contango, so that will be good. And then we also have another element here related to coal, and it's the fact that what is the COVID? It's basically, it's called the SARS-CoV-2. It's the it's the severe acute respiratory syndrome coronavirus 2. So the least thing you want to do these days is to burn a lot of coal and pollute the local air quality. So people are looking at what they are doing in South Korea, where they're closing close to half of the coal plants, and this is a health policy which is very important these days, and it doesn't cost anything because LNG is cheaper than coal. So I think that will create demand in the time. It will be probably not as good for coal prices, and I'm surprised that Newcastle coal is still at $65 per ton.
Yeah. Jefferson, I wanted to kick this to you now, just along the lines of what we just went through, in terms of the market reaction and where we stand today, and specifically, actually something I think Mark even mentioned too, around seeing a bit of a demand response in terms of people looking for a bit more length. Is that something that you're starting to see? And then how uniform is that across the asset curve? And do we see enough of a demand response where we start to see steams and older tonnage move as well?
Yes, absolutely. Because you really had rates bottoming out about a month ago, a couple of weeks ago. We still benchmark everything at the 160 to 165,000 cubic meter TFDE vessels, and then discount or premium to that. And rates were bottoming out around like the 30 to mid 35 to $40,000 per day, and since then they've been going up significantly. And it really is based on the multi-month charters that you have a lot of people coming in, and energy players and majors, and wanting to secure their shipping or make sure they have enough shipping through the winter period. So that requires them to do 6 to 12 month fixtures, which then pulls out available supply out of the market. It is, and that's really a lot of the volatility of spot charter rates in general is driven by what vessels are being put on multi-month charter, and you see a lot of sublets, and right now you're seeing both.
Could I just add, because
Sure.
One thing is the headline rates, which are up like 20% the last 2-3 weeks, but where we see the big difference is on the ballast bonus conditions. Where you were 3 weeks ago you were one-way economics. Now you are full round trip in Atlantic, and you are round trip to hub, typically Singapore in the Pacific area. So that contributes a lot more than just the headline rates.
Absolutely. Yeah, that's a great point. Yeah, that's a great point. And yeah, we're seeing the terms and conditions change as well. That's a great point. And also kind of wanted to make a point too about the ARB price. We've never been a favor of using JKM or ARB pricing to predict where the TC rates are going. Of course, it has an impact, and when JKM's at $20, then it's great for everybody. But you still have, and we saw this last year, situations where you're a long product, but you're short shipping. So you still need to move the volume. So rates can still climb and even spike in those situations. And,
Right.
and we're seeing that right now. Delivery of cargo is paramount. The people have to ensure that they're meeting their obligations to lift and deliver cargoes.
Yeah, from an equity perspective, there's definitely it's somewhat challenging for a bull freight thesis when you're talking about like a narrower arbitrage, because in a sense you've got a bit of a ceiling on it. But maybe a scenario like this could help kind of further kind of separate those two themes, where you really have distinct fundamentals from the midstream section versus the upstream, and maybe it won't trickle down to the same degree. I'm just curious, kind of on the other end of the market, and this is a good question for Mark and for actually for the entire owner panel, but in terms of some of the tenders that are out there now, kind of juxtaposed against the kind of systemic degree of slippage we're seeing kind of very quietly kind of around the world in terms of projects that were FID'd and greenlit. We've seen LNG Canada put half their workforce on to the side. That certainly seems like it's slipping. We've seen Golden Pass effectively on FID. Some slower progress on new trains in the Arctic, which I know are smaller, but I know certainly we're expecting a pretty big Russian build out. Some delays in Mozambique, and I think that the idea is that the supply curve is still going to be pretty steep, but it might just be flatter than people might think when we kind of look up from all this in 6 months. I'm curious in terms of participating in tenders to put tonnage into those projects. What do you do as a ship owner in that scenario? Does it impact your willingness to participate in those tenders? Or do you have risk parameters in place to where you don't have capital kind of stuck in the yard for tonnage that's not going to be needed for, it's going to be, needed a year or two after later than it was originally intended to. So maybe Mark, I'll start with you, because you guys have a pretty big term book, and Oystein, I know you guys and Golar are both, relatively active participants in that kind of business as well. But just curious, as a ship owner, how do you think about participating in those tenders when you see that degree of project slippage?
Sure. So we have, as you said, we have of the 47 LNG carriers we have, they're all on term charter. They're all at sea. We have nothing on order. And fortunately, not having speculative ships to bid into projects, the projects are, as you know, almost always late. Virus or no virus, OPEC or no OPEC, they tend to be late. The only exception that comes to my mind is one you mentioned, which is Yamal. It was fantastic execution. That's the first Yamal. So we welcome the delays, frankly, for Qatar and Aramco. We're seeing some and others. They allow us to continue to delever rapidly before we can also look at new build designs that are changing pretty rapidly and improving over what was done speculatively. We're supportive of the delay. We can use the breather ourselves at Teekay. The other thing that we're seeing, and we didn't participate in the Mozambique, but I understand there's been progress on that. The returns still don't look great for us on the new build side. I think there needs to be a reset or recalibration on the return side before we'll step back into the new builds. So just to kind of reiterate, we're in favor of this. We have no tonnage to put in. We are happy to delever. We want the rates to reset, and the technology is always improving. So the more recent we can get, the better.
And Iain, I'm curious what your thoughts are on that, and then specifically what Mark was referencing in terms of the new build return, and how that dovetails with the way Golar thinks about its LNG carrier fleet. Obviously, it's a business you guys have been looking to exit for a while. I'm curious, one, do you see this, or do you react kind of the same way to seeing that kind of slippage for global projects as kind of a welcome breather? And then, as it pertains to, the returns on new build and even secondhand tonnage, do you think we need to see the market reset before it's attractive to invest?
It's an interesting topic, because regardless of returns, we still see people piling in and ordering new ships. Obviously not right now, but certainly as soon as the rates take a turn up, we do have owners wanting to participate in it. As you know, Golar has not ordered a new ship since 2012. So we don't want to participate speculatively or on to try and bid into these charter rates, because 6%, 7%, 8% return is maybe what we can get out of these, from capital on new build shipping, just isn't good enough from us in terms of what we can do as alternatives, and in both the upstream FLNG and the downstream that we talked about earlier. The other thing about delays is they are inevitable. It'll be interesting to see what that does to the proposed the compression we're expecting to see in availability, this structural shortage of ships as we move through the next 2 years, and how long those delays are and what it does to that time frame vis-a-vis new builds coming out of the yards, and whether the new builds come out or are in fact delayed. So I think we've got a few interesting bits of the dynamic puzzle happening here.
Well, while I've got you, Ian, just to pivot a bit upstream, actually, I know we focus a lot on Golar Power and the different developments there, but if I think back to when we actually started to see third-party FLNG business getting done, the Hilli was born kind of in a market like this, where it kind of pays to be smaller and frankly a bit weird. It's not a 20-ton LNG export project in the U.S. Gulf, and being different in this kind of environment tends to matter. So I'm curious on that end. I know I would imagine inbound inquiry around FLNG is probably pretty muted right now, but if you look at the prospects for the next year or two, we've seen Sempra looks like they're still going to go ahead with Costa Azul, which is 2.5 million tons. There's some smaller projects in Canada, so the notion of smaller projects maybe inching over the line while the big guys are stuck could gain some traction. I'm just curious what your expectations are for the next year or two, and whether you think you can put another slug of capital to work in that market if that's realistic.
I mean, what we are seeing is we still see activity around FLNG. These projects do, as you know, take time to come to fruition. I think on BP with Gimi, which we're building right now, that took 2 years from the time we really started engaging seriously to take an FID. So there is a bit of background activity. I think one thing that will come to be when the industry gets sight of the future of LNG pricing, there will come a point where people will want to develop, customers will want to develop projects. And when that happens, having the lowest cost and fastest speed to market LNG and an FLNG solution is going to be very attractive, particularly if it's associated gas and not massive volumes. It's a way of monetizing gas, and even at $4 or $5 for the right location, that can be an economically viable prospect. And we have our 2 designs. We've got the Mark 1, which is Hilli and Gimi, and we're working hard on what we call the Mark 3, which is a new build out of Korea, just to satisfy a different market with slightly higher capacity. So it's not this year, maybe next year sometime, maybe the year after, but certainly it's still an area that we're interested in putting capital to work at the right time.
It seems almost silly to ask when you really look at what seems like it still has progress now, and you look back to 2014 to 2016, what actually made progress then. It was actually a relatively nice period for FLNG. So that's helpful. Oystein and Mark, I wanted to kick it to you guys and Ian as well. But in terms of looking at the next couple quarters, right? It's there's a lot of uncertainty. Maybe there's some silver linings and some green shoots around starting to kind of reemerge. But I'm curious how you think about managing your balance sheets and your cash, your capital commitments, and your return of capital in this environment, and whether your position or your thought process has changed from the beginning of the year. And then if you happen to be around for that period, which I know a lot of you were, how is it different than where we were in 2008 and 2009 in terms of your stance and how you were preparing your company for the remainder of 2020? So that's probably a good question for everybody. Oystein, I'll start with you, and then we'll go to Mark, and then back to Ian, if that works.
Yeah. So if you go back to 2008, of course, the LNG industry was totally different than today, and volumes was much lower as well. We went to like 200 million tons in 2010, and we are now at close to 400. So back then, it was all back-to-back shipbuilding contract, financing, and time charter signed at the same time. And back in 2008, I was in Knutsen, and we just ordered 4, tri-fuel ships on 20-year contracts. So it's a bit different then. You could get 100% financing from banks, and you didn't have to use capital markets, brokers, and all that stuff, and you could do it private. So it was very simple. Today, of course, it's a bit different environment, and we are kind of in what we call LNG 3.0 here in Flex, where we have a bit different kind of approach to chartering of ships and giving customers more flexibility. Of course, we have been very prudent on our kind of balance sheet. So of course, we are happy these days that we raised close to $1.3 billion of long-term debt financing last year, and that we closed the year with around $130 million in cash. So how has it affected us? I think it's affected us by the fact that we paid out 10 cents in dividend, despite we were making 44 cents in the fourth quarter. And despite the fact we booked Q1 at close to $70,000 on a TCE basis, which is a pretty good number.
Right.
So of course we are preserving more cash, and of course, you know, a lot of people will have a hard time. You know, there's been a lot of kind of Wall Street alchemy, where people have been kind of putting layers in the balance sheet with different bonds and preferred equity, and they thought it was arbitrage, and now they are realizing it wasn't arbitrage, it was balance sheet speculation. So those people will have a bit of a struggle refinancing bonds and such, which are coming to maturity these days. Or part, we don't have a loan maturing before July 2024. So we have a clean balance sheet, plenty of liquidity. And why do we do it? Because we have a business strategy where we're taking more risk than having very long-term contracts. And then we have to have a very strong balance sheet.
Mm-hmm. Mark, I'm curious, how do you think about the current environment relative to the crisis and even kind of the energy trough of 2014 and 2015, and how is Teekay preparing to manage its cash flow and its balance sheet for the remainder of the year? And is that any different than the way you thought you would heading into it?
Sure. As you say, there are actually kind of three periods we can address. The first one was 2008 and 9, the financial crisis. And as you know, Mike, we were around then. CGP was certainly around. At that time, we asserted that there'd be no change to our EBITDA, despite our share price falling in concert with everyone else. And that was indeed the case. And we're repeating the same thing now. We have extraordinarily long cover. It's even higher and more diverse than it was then. So with our fleet 98% fixed through the end of the year and over 96% fixed next year, we are not suspending our guidance. We are not changing our guidance. That's where we are. When we turned to 2015, that was painful for us, as you know, Mike. We had to cut our dividend to something sustainable. It's been building back from then, but now that the dividend is sustainable, we have certainly no plans to cut it, and so people can rely on the distribution. It's in terms of cash, we're over $400 million of liquidity. We are seeing people drawing down on revolvers, refinancing as early as they can. We also are going to want to try to get ahead of the curve on that. But in terms of what we're going to do with the cash, we have been buying back. These are pretty good prices in our opinion. And we have, unfortunately, the ability to look at almost anything in our capital allocation program right now, given the situation we're in.
Okay. Iain? Your thoughts on managing your balance sheet? I know when you guys do dive into projects, they tend to be relatively big checks. So I'm just curious how you think about managing it for the rest of the year, and is that any different than how you thought you would in January?
It's no different. I mean, what I would say is, as a starter, is there isn't a company in the world that isn't looking very carefully at you know, cash reserves right now, and I think that goes without saying, really. You know, if you look at our two ends of CapEx, we've got the GIMI project, which is a fairly chunky capital machine, but that's being paid right now. We've got our $700 million facility in place, and that's been drawn down for most of this year, with a little bit coming in from us towards the end of the year. And at the other end, in Golar Power, as I said, we've got COD, and we're starting to generate cash from our 25-year power contract, and that'll be used to develop the downstream business within Golar Power. And then finally, the ships in the middle, which have been historically a bit of a problem child for Golar, all being in the spot market. Compared to my colleagues, some of our colleagues, we're still not that high as a percentage, but we have 60% of 2020 backlog already booked, which for a spot fleet is actually pretty high. So you can see the change in the strategy there. So that's our story.
Gotcha. That's helpful. You know, we're just about out of time, but I do want to just kind of put one more general question out, and I'll start with Jefferson. Just in terms of there's a lot. There's a lot going on. There's a lot flying around between the OPEC pricing war, COVID, depressed commodity environment. It's been an interesting quarter to say the least. But as we look out into Q2 and Q3, what's one topic, and it could be LNG related or market related, that you keep looking at that you think the market should be paying a little bit more attention to than it is right now? And I think there's probably, in this kind of environment, there are probably more of these valid answers than ever before because there's so many different permutations. But I'm curious, like Jefferson, in terms of what you've seen in the market, what you've heard people talk about, what's one thing you think probably needs to get more attention over the next couple quarters, or will?
Well, on the downside, would definitely be paying attention to cargo cancellations out of the U.S. Gulf. If we see that actually occurring because of just the low price arb. But on the upside, I'll be paying attention to replacement of steam turbine vessels. So because there is such a large efficiency gain for a lot of the charterers out there between using the modern tonnage versus some of the older tonnage. And there is a lot of older tonnage still owned by a lot of the projects out there. Are you going to see them swapping out of the steam turbines and into the more modern vessels?
We can talk about that for an hour, but Oystein, I'll kick it to you. What's one thing you think that the market isn't talking enough about right now?
I've been talking a lot about getting rid of the steamship, so I won't mention that again. But but I think it's the cheapness of LNG, and with the price crash of oil, LNG is going to be very cheap, and we are talking about $3 to $4 per million BTU, maybe even lower. And right now, coal is like $4 on equivalent pricing when you are taking into consideration the fact that a coal plant is much less efficient than a gas power plant. So, of course, we will be drowning in a lot of cheap LNG, and that's going to create demand and create the demand for freight.
Mark?
Well, we really batten down the hatches on the business side, so I'll just turn to something that everyone is talking about, but they can't talk about enough. It's our crew and the colleagues. I don't know where this ends. It's going to get tough. So that's where our thoughts are now that our business side is locked up to the end of the year.
Very fair. Yeah, Iain?
I got a comment on the crew, but an additional one is FSRUs. I mean, FSRUs take forever to get contracts to put in place. We're trying a different approach to develop our own markets and put our own FSRUs into our own terminals to try and accelerate it. With cheap gas, as Oystein's saying, cheap LNG, we should be doing far more of that around the world for places that need power to displace, fossil fuels, animal fuels, that sort of thing. We really need to do more as a group of people to bring gas to the masses. So FSRUs.
Speeding that process up is probably another hour-long conversation, so we'll save that. But all right, well, I think I'm getting the hook from Capital Link. So I want to thank everybody for joining us, and I want to thank the panel. This has been super helpful, and really appreciate you taking the time. And so with that, we'll say goodbye. So thank you very much, guys.
Thank you very much.
Good to see you. Thanks, everyone.